and welcome to a new virtual investment summit by Fan Society. Today we're going to talk about global emerging markets with China or without China, and it's specifically this topic which is going to be what our experts from Eastspring Investments are going to talk about. These days there's been in China a lot of headlines. We have headlines about COVID, we have headlines about slower growth, slower economic growth. This specific week, there's a lot of headlines about geopolitics too, with the relationship between China and the United States. But there's some questions about if China is ready to reset the button for the second half of 2022 with a major stimulus package, or if it's going to take a little bit longer to have growth in the region. This is going to be a panel with several experts, and afterwards there's going to be a Q&A session. You are invited to post your questions for the Q&A session either through the WebEx event application, or you can also do it through the LinkedIn chat if you're following us from LinkedIn. There's a third option. You can send us your questions directly to info@fansociety.com, and we will pose the questions to the panelists. You can do them in English or in Spanish. Today we're having a very broad audience with followers listening from the United States, from Latin America, and from Spain, so welcome all. And for the Spanish audience, I have a specific message. I'm going to turn to Spanish for a minute. Esta sesión computa para la formación continuada de EFPA. Cuando finalice la sesión pueden acceder a la web de EFPA y ahí estará el test dirigido a esta sesión y computará para la formación continuada. So now I turn back to English and I want to introduce our first guest. It's Matthew Applestein. Matthew is Managing Director and Head of America's Business for Eastspring Investments. Welcome, Matthew. He has more than 30 years of experience in the financial markets, so I guess he's seen it all. He's worked at RBC Global Asset Management, All Mutual Asset Management, and Fidelity Investments before joining Eastspring Investments, and right now he's based in Boston. Welcome, Matthew. Please go ahead.
Thank you, Alicia. Thank you all for joining us today, and really let me thank Fund Society for being such a great partner. So I'm Matthew Applestein. I run the Americas for Eastspring Investments. For the newcomers, we're a $258 billion asset management firm headquartered in Singapore. We have one of the largest on-the-ground presence in Asia of any asset management firm in the world. And what we bring is that Asian lens to the marketplace. Today, we're going to leverage that Asian lens to bring you the next in our series of our Asian expert webinars. So today, the timing is really appropriate to talk about China. Today's Wall Street Journal talks about Didi delisting from the New York Stock Exchange. And we're very fortunate to have several people here today to talk about that. We're going to go at it from two aspects. The first is the China market itself. Ken Wong is going to join us from Hong Kong and talk about the China market, what's going on there, give you some insights. We're then going to turn it over to Navin Hangarani, and Navin is going to talk about the global emerging markets perspective. China is so large. What's it doing in an emerging markets portfolio? That crowding on some of the smaller countries. And he's going to give us some insight there. Where we're going to start with Adam Matthews. Adam joins us from Singapore. He runs the Client Portfolio Manager Group. He's going to give us an overview of the market and some insights at a high level, and then turn it over to Ken and Navin to follow on. So we hope you enjoy the webinar today. Please, again, feel free to put the questions in. And Adam, I'm going to turn it over to you.
Great. Thank you very much, Matthew, and thanks to everyone for joining us today. I think we have a really interesting session, as Matthew pointed out, and it's very timely. First, let me start with a quick summary of what we said back in December. If we can go to our first slide, I think it's slide number 6. Now, in December, we thought that growth would shift slowly from US leadership to GEM in Asia as the post-COVID reopening kind of migrated to this part of the world. China's resurgence in COVID cases and their harsh multi-city lockdowns pretty much stopped that rotation in its tracks. Parts of the rest of Asia did reopen. Here in Singapore, we are almost completely reopened, and also Southeast Asian markets reopened. But much of North Asian markets retained at least some mobility restrictions, and this had a fairly meaningful impact on recovery in the region. In 2021, we did forecast that inflation would creep up, but of course, we didn't anticipate the Russian-Ukraine conflict, which created a huge level of uncertainty around energy and food prices. We also thought the Fed might even be in a position to walk back its stance on tough tightening, or its tough stance on tightening, but as they often have done but with inflation now running at 8%, that looks pretty unlikely for the remainder of this year. So in our December call, we did highlight the ongoing recovery in the value style equities space, especially in markets like Asia and Japan, which are more biased to cyclical industries. And that turned out to be the correct, at least style positioning call. Finally, we called out what we see as a potential to separate China and GEM ex-China into standalone allocations. Now, this just makes a lot of sense to us for a number of reasons. So we continue to draw our client attention to this sort of alternative portfolio construction approach to GEM to GEM ex-China and China. Now, for the remainder of 2022, we turn to slide number 7. The rotation story isn't dead, but it certainly is further delayed. Now, China will at some point move to a post-COVID environment. We're sure of that, but lockdowns need to end and the stimulus needs to be ramped up to plug that potential output gap that we're going to see this year. This is also impacting the rest of Asia and probably the rest of the world because China is such a large trading partner. It's certainly having a knock-on effect onto supply chains, which are further exacerbating inflation. Now, China's stimulating its economy and is likely to do more work on that area. Remember, China's operating a counter-cyclical monetary policy to the Fed. While rates are rising in the US, they're actually falling in China. But are these really enough to offset the collapse in Chinese consumption we saw due to COVID lockdowns? Now, China A shares, they've already corrected over 30% from their peak in February last year. So this bear market in China is already priced in quite a lot of bad news, and Ken's going to pick up some of those areas in more detail. We also continue to believe for the rest of this year that value equities will outperform other investment styles in Asia and GEM in the light of this rising rate and rising or higher inflationary environment. And we continue to explore this idea of separating GEM from the rest of China for reasons that we'll go into in more detail. Now, China is a huge component of any Asian and GEM benchmark, as Matthew alluded to. And it's been one of the hardest hit markets across the region so far this year, as we can see here on the next slide on page 8. So we just turn over to page 8. On this slide, of course, energy and commodities led performance year to date. The only market actually in Asia to show real positive returns was Indonesia. And given it's a large exporter of energy and agricultural commodities, it's really reopened its economy. Now, also income-related securities outperformed, including dividends, given the shift away from more long-duration earnings. China and tech markets led that underperformance so far this year. So given this kind of sea of red, let's look back at what made us more bullish on markets at the beginning of this year. And we can really see that over on the next slide, which is slide number 9, where we look at PMIs. So if we can just go to slide 9. Yep, thank you. Global and Asian manufacturing PMIs were still going strong at the start of this year. China, okay, manufacturing PMIs were already starting to drift lower in January, but we hadn't yet seen the kind of lockdowns that appeared in March. Now, since March, Chinese data has really been pummeled, and in many cases to levels that are as bad as what we saw in the original outbreak back in 2020. On the right-hand side here, we can see a clear divergence between China, represented by the gray line, and markets like India or Malaysia, where PMIs have remained largely positive. Now, if we look at the service sector PMIs over on the next slide, this is slide number 10 we're turning to, the picture looks even worse. And services were more affected by lockdowns than manufacturing, because some of the export manufacturing zones in China were able to remain open over the last few months, but most services, of course, had to close in those afflicted cities. One data point that was well publicized in the last few weeks was that the city of Shanghai sold no passenger cars in April. That's 0 passenger cars. Now, since the partial reopening of lockdown cities, Chinese high-frequency auto data sales has rebounded in May, but still remains down 20% year on year. Consumers definitely remain nervous, and unemployment is now starting to rise in China. But as we look forward over the next 6 to 12 months, we need to look at what trajectory any reopening in China would take. And of course, if China's steady state economy can return to those kind of pre-COVID levels. Now, obviously, the government does recognize the risks here and is leveraging its usual toolkit to offset the slowdown in growth. And we can see that really over on slide 11, the next slide. The government answer here has been to release credit into the system in attempting to stabilize the property market with cheaper available mortgages, and to ramp up infrastructure spending on the left-hand side here. This was showing signs of traction in the first quarter as we saw credit demand starting to rise along with that infrastructure investment. However, even in the last month, these data points were hit by lockdowns, with credit demand in April came in less than half of what was expected. Now, the government needs to continue to accelerate economic support to meet their growth targets this year. And remember, we have this rather important Chinese Communist Party Congress in November, when Xi Jinping is likely to get conferred for another term. So there's a lot of motivation to wrap the COVID crisis up quickly now, and to get growth back on track for the remainder of this year. But we also just want to look at the possible fallout of the geopolitical realignment following the Russian-Ukrainian conflict. And we have several details over on the next slide, slide 12, please. So let me just draw a few highlights out of this slide here. And what are the long-term implications for the Russian-Ukraine conflict on China and the rest of Asia? There's 3 key things here. One is, as energy and food security concerns will surely be elevated after this conflict. Higher commodity price volatility will likely last as the conflict continues, and vulnerability of some Asian countries to energy imports will drive investment in both conventional and alternative energy. The second area is the strength of the Western alliance. I think caught many over here by surprise. And I don't mean the US-European alliance per se. I mean the European or EU alliance, where they responded so quickly to the situation in Russia and Ukraine. One needs to question whether China would really jeopardize its long-term trading relationship with Europe, which is a bigger trading partner than the US for China, over their own alliance with Russia. And remember, China's trade with Europe is about 5 to 6 times greater than their trade with Russia. And I think the third point is the financial system. This is getting a little bit of airplay now, but the conflict really has been a wake-up call that the Western allies have been able to seize central banking assets and deprive local Russian financial institutions from US dollar-based settlement and trading systems. This will likely lead to further unbundling of China and possibly even other countries' financial systems to create more independence and their own parallel arrangements. That would really imply, and I think we're looking over the long term here, 5+ years, but less reliance on US dollars, and in particular probably US treasuries held with the Federal Reserve, which could add additional upward pressure on US rates. Now, this could have an ongoing impact on central banks around Asia as well. And we dive into this a little bit on slide 13. If we can turn to the next slide, please. Parts of Asia, like India and Indonesia, are experiencing commodity push inflation. But India has traditionally been a net exporter of food, and Indonesia both of food and energy. So some of these countries experience both the positive and the negative impact of commodity inflation. Other markets like China saw CPI actually fall in March and April, partly on lockdowns, but also partly on local food prices, in particular pork, which have been falling. Pork prices have been falling in China this year. So the suggestion here is that in Asia, at least for now, and this might be a rather short-term outlook, but Asia seems less impacted by kind of surging inflation, given that output gap we're still seeing here. And that means Asian central banks will likely lag behind the Fed a little bit. On the next slide, slide 14, while the economic recovery in Asia has been a little bit tepid in the last few months, largely due to that China ongoing COVID lockdown situation, valuations have already adjusted. Sorry, we're just, here we are on slide, this is the right one. Valuations have already adjusted downwards along with earnings revisions. However, there may be some more modest downward pressure on earnings to come. Now, EPS growth forecasts in 2022 and 2023 for Asia remain at around 11.5%, respectively, for both of those years. And while that's decreased by about 3% over the last 3 months, there could be more compression to come in the event of slowing global growth. Of course, much of our returns as investors depends on the price we pay for assets. And if we turn over to the next slide, slide 15, we can see that China A shares and MSCI China valuations are already trading at one standard deviation cheap on a price to book basis. Some of the Southeast Asian markets are also trading at discounts. Now, we've used price to book Z scores here against a 12-year rolling average. Could valuations fall further? Yes, of course they could, in the event of a, say, possible U.S. recession. But this isn't our base case, at least not for the second half of 2022. It starts to become a possibility, perhaps in 2023, according to our multi-asset team. But again, we need to see much further deterioration in growth from here. I'm going to take a pause here, and I'm going to come back and do a quick summary after our next two speakers. And now I'm going to turn it over to Ken Wong, Ken based in Hong Kong and covering our China A shares and our all China capabilities. So Ken, over to you for now. Thank you.
Well, thanks everyone for attending our session today. And what I want to do now for the next 10, 15 minutes is talk more about some of the things that we're seeing on the ground, in particular in China, and really give a glimpse in terms of why we feel, for the remainder of this year, there should be specific, both fiscal as well as monetary policies, which could help stabilize the market, especially as what Adam mentioned earlier. We are very much in a very political year where President Xi Jinping is highly expected to be, sort of put in as a third term in regards to being the president of China. But let me, just start my presentation. And I want to show everyone specifically some key facts, because if we look at specifically what's going on, and we can turn to the next page, what I want to show you very clearly is that, over the past 25 years, when the S&P 500 has seen corrections of more than 10%, we've seen that, a number of times over the past 25 years. But basically, the China A share market, which is the domestic onshore stocks traded in Shanghai and Shenzhen, they outperform significantly. So basically, if you look at that 25-year period, average returns, specifically for the S&P 500 when they correct, fell by roughly about 19%, when we did see a correction. But then when you look at the China A share market period, it only fell by 7%. So basically, during these specific periods, on average, the Chinese A share market had outperformed the S&P 500 by about 12% on average during these specific periods. Now, obviously, I'm not a fortune teller, and I can't tell you this is going to happen every single time. But I look at this as as a very long-term perspective. I look at specifically, China A shares as a very strong complement to investing, sort of within, let's say, your global portfolios, because the overall correlations with the A share markets compared, or comparing that with the US market, is very low. Now, we all talked about specifically what's going on in China, and everyone knows what's going on. If we look at the next slide, what you can see is just that there's been a lot of talks, and there's been a lot of discussions around COVID and how that's impacted China. Well, obviously, it's made a major impact when it comes to looking at what's been going on in Shanghai. But the fact is that we have seen a number of COVID cases popping up, not just only in Shanghai. We've seen it more recently, and more cases in Beijing, and we've seen other spots actually picking up as well. And specifically, if you look at how much sort of GDP might be impacted, or what's that overall contributions, it's fairly high. And if you look at where we are today, right now, Chinese leadership still feels that China can still grow their economy by roughly about 4 to 5% this year. But a lot of the analysts that we've been talking to, and they've been announcing more recently, that they're actually lowering their expectations for China's economic growth to anywhere between 3 to about 3.5%. For us right now, Eastspring, especially with our onshore domestic, we feel China's economy should still grow roughly around 4% this year. But obviously, there's going to be a lot of challenges, and we feel there's going to be specifically a lot more policy support during the second half of the year in order to support this specific economic growth that China would like to see. Next slide, please. And of course, some of these overhangs, and what are some of the key concerns right now within China, as a result of, sort of the recent COVID restrictions? Well, there's a few things. Number one, if you look at the left-hand side, we can see specifically that the property market has slowed down drastically over the past 12 months. Now, there's been a lot of talks around, sort of late last year, when you had some defaults from some of the Chinese property developers like Evergrande and some of the other smaller ones as well. And, that's created a lot of negative sentiment. And then it was very difficult, when it comes to, getting mortgages, because there was, a bit of a credit crunch happening. And so a lot of these things really had a deterioration or a demotivating factor when it comes to, sort of individuals who wanted to buy properties. But, just even over the past couple of days, we saw how the Chinese regulators have actually asked all the banks, sort of in the meeting yesterday, to actually, ask these Chinese banks to extend credit and to actually, try to help, promote more credits for individuals who want to purchase homes. So we feel that this is starting to be a bit of a turn, and we are expecting to see specifically the property sector having a bit of a rebound as a result of this. This is also one of the reasons why one of our key holdings right now in our portfolio includes a Chinese property stock as a result. And then, of course, the other key aspect is around consumption. The fact is that because you have lockdowns in China, that's had a very deep impact when it comes to overall consumption. As Adam mentioned earlier, basically Shanghai had no auto sales previous month, and then this month things are hopefully gradually coming back to back to speed. If you look at our Shanghai colleagues right now, they're able to leave the house for 4 hours a day. Specifically, with the pass, they're going to be able to go out and buy the necessary products, and we expect them to be actually back in the office within the next few weeks. So they're pointing signs in the right direction, but we know for a fact that consumption does definitely need to grow. Next slide, please. The other key aspect when it comes to when we talk about China is the fact that when you compare the overall interest rate, basically the government yields for Chinese government bonds and the U.S. government treasuries, you can basically see that when we compare the 10-year Chinese government bond with the 10-year U.S. treasuries, basically their spread, their yield gaps are 0%. And in fact, if you look at the recent numbers over the past few weeks, the numbers actually turned negative, in which the U.S. 10-year government bond yields are actually slightly a little bit higher than the Chinese 10-year government bonds. And so, we're in a notion right now where this divergence when it comes to interest rate policies and specifically what's happening between the two countries. We know for a fact, because of the high inflation rates in the U.S., the Fed is going to have to continue to raise interest rates. So that's definitely going to have a push up when it comes to the overall yields for a lot of the U.S. Treasuries. On the other hand, China is actually continuously is in a sort of more downward trajectory because CPI inflation is quite low right now. It's about 2.1%. We expect for even sort of at a peak CPI potentially should maybe peak at around 3% later this year. Because of that, the PB in China has the ability to continue to lower interest rates if needed. Because as I mentioned earlier, Chinese government will have to have a notion of both fiscal as well as monetary policies in order to help combat specifically what's going on with the slowdown in China. But that's not going to be enough. More needs to be done. If I can turn your attention to the next slide, specifically, if you look at what's going on, right? We talk about, is policy easing helping? Well, it is to some standpoint, right? We know for a fact there's going to be more monetary policies being, inflected within China, specifically in terms of lowering interest rates, in terms of specifically providing more liquidity into the system, extending credits. We know for a fact that more fiscal policies will be enacted, specifically with more infrastructure projects, more financing abilities. Just over the past day, we've had tax cuts and tax rebates already. But the thing is that it only benefits certain companies and certain sectors, and that's why we feel that more needs to be done in order for China to really have a strong second half. So while monetary as well as fiscal policy will help, we think one of the key aspects will be the regulatory concerns. Adam earlier noted, specifically, or talking about Didi and specifically what's happening there with the delisting, and the fact is that when you think about a lot of these things, there's an impact for some of these overseas listed Chinese companies, whether they're listed in the U.S. or listed in Hong Kong. But the fact is, when you look at the China A-share market, the onshore market, they don't have specifically a lot of these geopolitical concerns, or they're not, exposed to a lot of these geopolitical concerns. And that is why we feel that, investing in the China A-share market definitely does make a lot of sense for investors. Next slide, please. Now, the other key aspect when it comes to, sort of talking about China, we focus very much on the global supply chain. Now, if you look at the light, sort of diamond figure, and then sort of the darker sort of figure, basically the light figures are more lower value added industries. So specifically, sort of the garment, shoes, and toy, type of manufacturing. And then sort of the darker dots on the plots are more higher value industries, which is specifically, sort of the high tech manufacturing, sort of the machineries, sort of the electrical parts. And the fact is that, what you want to be is you want to be sort of on the right side of this particular graph here, because basically what this shows is it provides specifically, better efficiencies and basically higher quality of labor. And of course, the lower the GDP per capita, and specifically the more innovative and more technological when it comes to advantages over supply chains, the better you are. And of course, if you look at this particular chart here, China still very much leads the way because they can offer cheap labor. They can offer specifically high quality labor as well, as compared to a lot of developed markets or emerging economies. So this is one thing that China has a very unique advantage on the global supply chain. So when people talk about decoupling and when people talk about, do we really need to have China for a lot of these, to be sort of a key exporter? Well, the short answer is, at least for the foreseeable future, it's still very much going to be China because of the fact that, they're still able to provide very high quality labor at a very low price. Next slide, please. And the other key aspect when it comes to, if we can go back to the previous slide first, just very quickly touch up on the valuations. Chinese equity markets right now are some of the cheapest markets right now when it comes to overall PE ratios. Both China offshore, which is the second to left bar chart there, and then the China A-share markets, they're actually some of the more attractively priced markets right now, when it comes to investing. So for investors who are looking for opportunities and looking for value, or looking at market, what their intrinsic values are, the Chinese markets are definitely very attractive at this moment. And we think that a lot of the negatives have already been priced in. Next slide, please. And more importantly, when it comes to the China A-share market, one of our key aspects and one of our key beliefs right now is the fact that the ability to have a very diversified and a lot of differentiated exposures within the marketplace is very key. When it comes to the A-share market, what you can actually see is that across a variety of spectrum, whether it be consumer discretionaries, industrials, healthcares, these are key sectors that there's plenty of opportunities when it comes to stock selections. There's over 4,200 companies right now listed in the A-share market. Compare that with, let's say, the US listed ADRs. There's only about 200 some odd companies there. Or if you look at specifically the companies listed in Hong Kong, there's only roughly about a little bit over 1,100 or so companies, Chinese companies, which are listed in Hong Kong. So if you want to talk about diversification and the ability to specifically have more choices when it comes to stock selections and to have a much more focus on the domestic economy in China, we feel the Chinese A-share market is the way to go. Next slide, please. So this is our expectations right now for China's economic growth. We feel China should grow roughly about 4% in 2022. We are still bullish as compared to maybe some of the analysts who have downgraded their GDP forecast. But the fact is that we still see strong areas coming, or strong contributions coming from manufacturing, as well as being a beneficiary of supply chain resilience. The fact is that there are a few things which have been going against China. I mentioned earlier property as well as specifically consumption. But we think potentially in the second half of the year, there will be a turnaround, whether it be from credit easing to help properties, and then specifically, more fiscal as well as monetary policies, and potentially, further initiatives set forth by the central government to push consumptions. So right now, they're negative contributors to China's economic growth for this year. But we feel in the second half of the year that these things will turn. And in fact, they're going to be, we potentially could see surprises because of potentially, seeing a lot further support in these particular areas. So that's why we're still, while the economy is slowing down, we're still maintaining, a fairly cautious, optimistic belief in the second half of the year that economic growth can still roughly come in at roughly about 4% for the full year. Next slide, please. So I'm going to end my talk before I hand it over to my colleague Nevin on a few key notes here. So what I want to do is provide a few insights as to kind of where do we see China right now, sort of over the short term. Specifically, if you look at in the short term, both there's domestic as well as external factors here. But overall, some of the key things we have to keep in mind is that overall sentiment right now in the short term is definitely still weak, and that has weighed overall market performance. But the fact is that valuations in both the onshore as well as the offshore Chinese equity markets are near historical troughs, right? And they're becoming more and more attractive. A lot of negatives have already been priced into the Chinese equity markets. But the fact is, in the short term, what are going to be some of the key catalysts in order for investors to see, sort of to actually be willing to invest? What they need to see is more fundamental improvements to help boost their sentiment. And we feel that these are things which will gradually start to happen, especially when we get into the second half of the year, because of more relaxation of various government policies, which is definitely going to help stimulate the ability for a lot of these Chinese corporates, to grow and see better earnings improvements, for the remainder of this year. And then my final slide, please, if I can turn to the next slide. Long-term belief. Now, China, especially when you look at China and the China A-share market, there's still to like about what's going on in China, right? We know for a fact that overseas investors are going to still continue to increase their allocations to China. Let me give you this one key fact here. Chinese A-share market right now, if we took out, sort of free flow, inclusion factor and everything else, the Chinese A-share market represents about 11% of the global market cap in the world. US is obviously the biggest at 30+%, but is at around 11%. The fact is that China Asia market at 11% is so underly invested right now from investors that we feel that overseas investors, as time progresses, will see the disconnect between how big the stock market is in A shares, and specifically how little that investors are actually investing in that market. Chinese households are also going to increase financial allocations to equity products. Right now, if you look at an average US investors, as we all know, they could have anywhere between 30, 40 plus percent of their assets in equities. The fact is that when you look at a Chinese household, they're about at 10%. And the fact is that the whole retirement scheme systems in China is still very much underdeveloped. So we feel as time progresses, there's going to be a lot more schemes and a lot more households in China who will want to actually allocate more of their investments into into stocks. And of course, the Chinese economy structural shifts remains intact. So we feel specifically because of these key areas that the long-term outlook for China and for specifically investments into China from both external as well as internal factors are going to be very important, and investors should not neglect these points. So with that, I want to thank you very much today. And I now want to hand the floor over to my colleague, Nevin, who's going to talk to you more about the proposition when it comes to investing in the global emerging market, ex-China. Nevin, over to you.
Thanks, Ken, for the introduction, and thank you, everybody who's joining us today. So, as Ken mentioned, I'm going to be discussing the other side of the equation, touching upon what has happened to the emerging markets index over the course of the last 20 years, and what we think investors should be thinking about given some of the changes that we have seen. So if we could go to the first slide with the presentation, please. So over the last 10 to 20 years, we've seen lots of changes in the EM index, but the most prominent of which has been China's dominance. Now, we're in a situation right now where China is 30% of the emerging markets index. It has grown over time, and we believe it is likely to continue to grow over time. One of the consequences of China's dominance of the index is that we believe other markets have been marginalized by investors. Now, why this matters is that investors go into emerging markets to be able to capture diverse return opportunities. But as one country becomes dominant, that means that those return opportunities that they were seeking to get from a diverse range of countries are diminished. So what are the options that we think investors have? Well, we've laid out 3 options on this slide. The first is that investors can maintain the status quo, keep their existing emerging market manager and rely on that emerging market manager to allocate appropriately. The second would be to keep their existing emerging market mandate and to appoint a complementary China-only mandate. And we would expect that if investors did that, it would be a mandate that focused on the A-share market, which is under-owned in EM portfolios at the moment. And then the final option, which is something we'll touch a little bit more upon today, is to take the EM mandate and to split it up into an EM ex-China mandate with a discrete allocation to China. And we'll delve into some more of those points now on the next slide, please. So this shows us how the EM index has changed over the last 20 years. So when we go back 20 years ago, the 3 largest markets in the index, Korea, Taiwan, and South Africa, had a total weight, cumulative weight of 40%. The largest market back then, Korea, did not dominate the index. But I'd like to draw your attention to this green line. Now, the green line here is a combination of other countries who in aggregate, their weight came to 40% of the index. You go through to 2010, China had become the largest country in the index, but it still wasn't dominant. But what we've seen over the last 5 years has really been remarkable and something that we haven't seen in the history of the EM index before. So China's weight has more than doubled. And if you just go back to the end of 2020, China's weight in the index was 40% of the index. Now, China has sold off for some of the reasons that we have discussed, but even today, at more than 30%, it is more than 2 times the weight of the next largest market. We haven't seen this before in the history of emerging markets. Another point I would raise here is that at the moment, the A-share inclusion factor for A shares in the MSCI index is only 20%. Now we expect that A share inclusion factor will increase, and if it increases to 100%, then the weight of China in the index would be 44%. The next largest country would be 13%. So you can see we've got a structural reason why we expect China's weight to increase. And as it does, it will only become more and more dominant in the index. Now, over the course of the last 20 years, of course, we've had countries coming into the index, countries going out of the index. The last country to leave the index because it was upgraded was Israel. We've had some countries being downgraded, the most recent of which was Greece. But when we look at what's happened to some of those other countries, the green line that I mentioned at the beginning, that was almost 40%. Those countries that together didn't aggregate to a lot, but if you take them now, that 40% has come down to less than 10% of the index. We've also seen a huge pivot towards Asia. EMEA and LATAM used to be 45% of the index back in 2010. Today, they're around 20% of the index. And that 20% is even after the entry of the countries in the GCC, the Gulf Cooperation countries, Saudi Arabia, Qatar, Kuwait, and the UAE. Now, together, those markets are now 7% of the index. But really, these new entrants to the index, these new markets that have come in, have really just been lost with China's dominance of the index. If we could go on to the next slide, please. So what does this mean? Well, at the moment, if you're an investor in emerging markets and you like China, then you'll not really be able to own more of it without marginalizing the other countries. If you're an investor who doesn't like China, then China is still going to be the most dominant country in your portfolio. So what can an investor do? Well, we're suggesting that investors can think about separating China from their EM portfolio. That way, if you like China and you want to own more China, then you can make that decision. Similarly, if you're in a position where you want to own less China, you can do that. But one of the consequences of China's dominance of the index has been, as I mentioned, the marginalization of other countries. And on the right-hand side, we have a selection of those countries here from across EMEA, LATAM, and Asia. Now, when you go back to 2015, the cumulative weight of these countries was 20% of the index. Those countries are now 9% of the index. So their weight has more than halved. And what we have seen at the same time, when you look at the graph on the left-hand side, is that their valuations are now trading at 1 standard deviation cheap compared to where they've been. So the red triangle shows you their current valuation, and the little gray rectangle shows you where they've been historically. So these countries are now 1 standard deviation cheap. So for me as a portfolio manager looking at these markets and as a value investor, I think they represent a great opportunity for a bottom-up stock picker. We're finding markets that have been forgotten about by other investors, that have been marginalized, and they're now trading at cheap valuations. I'd also add the point that given the weight that some of these countries are currently in the EM index, if I just take an example, such as Malaysia or Indonesia, both of these countries are around 1.5% of the EM index at the moment. The reality is that a high conviction manager probably is only going to be able to own 1 or maximum 2 stocks in those markets. That means that there are a lot of opportunities that are being missed. If we could go on to the next slide, please. Now, this just shows graphically what's happened in terms of flows. So the red line shows the foreign flows into China A shares, and the orange line shows what's happened to the flows into EM ex-China. So what you can see is that since the middle of 2018, we have had $100 billion worth of outflows from EM ex-China. Now, at the same time, you've seen a significant amount of inflows into the A share market. So again, it just touches upon the fact that we think that these markets are being forgotten about by investors, given the current construct of the EM index. The next slide, please. So what does EM ex-China offer to investors? Well, what we've shown here is the MSCI EM index for both EM and EM ex-China. So the left-hand side shows you the EM index. What you've got there is a universe of 1,400 stocks, but more than 700 of those stocks come from China. So more than 50% of the total stocks in the EM index are Chinese stocks. The right-hand side shows you the EM ex-China universe. So you've got 700 stocks. That's still a very large pool for a bottom-up stock picker to be able to find opportunities. But what you see is you don't have that concentration, the same as you have for China in the EM index. And in short, if you take a country that has 50 stocks, that country in an EM index can largely be forgotten. That same country with 50 stocks in an EM ex-China universe becomes a lot more relevant. Next slide, please. So an actual question is the EM ex-China universe investable? Do we have enough large companies and are they trading enough? And so we've got some data here to support the belief that it does. So when you look at the universe of stocks in EM ex-China, we've got 1,200 stocks which have got a market cap of more than $2 billion. Now that is more than you have in the EU, more than you have in Japan, more than you have in the UK. And when you look at those stocks with more than $2 billion market cap, and you ask, okay, are they liquid enough? When you look at the chart on the right-hand side, the answer is definitively yes. The liquidity for those stocks with more than $2 billion of market cap in EM ex-China is equivalent to the liquidity that you get in Asia as well as the EU ex-UK. And so we believe that given the size of the market, given the liquidity of the market, that EM ex-China is an investable asset class on its own. And actually, it's interesting to note the market cap of EM ex-China is larger than the market cap of Japan. And Japan is a market which has for a very long time supported discrete allocations from investors. The next chart, please. Now, one of the things we think may have been forgotten or may have fallen under the radar is actually EM ex-China has significantly outperformed EM over the last 10 years. So when you look at it, over the last 3 and 5 years. So when you look at it just over the last 3 years, we've had 10 percentage points of outperformance over the EM index. Now that is a significant amount. And when you consider that this is a market that has actually had outflows, that is trading at cheap valuations, yet it is still outperformed by 10%. So we think there is a compelling opportunity here to be able to look at EM ex-China. And the next chart, please. So we've got a couple of stock examples here. Stocks that we believe have been marginalized and forgotten about by investors given China's dominance. And the first of these is Life Healthcare. Now, Life Healthcare is a South African listed company, which is a private hospital operator, and it also has a medical diagnostics business in Europe. It used to be a darling of the market. It was a very hard stock for a value investor to own. As you can see, it used to trade at north of 2.5, 3 times book. It was a stock that sold off for a number of reasons. It sold off because they started feeling some pressure in their domestic market from increased competition, from insurance providers having increased oversight over claims, as well as the fact that the acquisition they made overseas had a large presence in the UK, and the UK then went through Brexit and subsequent events to that. But the market started to price in permanent loss of value, in particular after COVID. The market assumed that people were no longer going to go into the hospital for elective procedures. The market did not take into account what was happening in the company with respect to their competitive position. And eventually, it reached the point where it started to trade at less than 1.5 times book. Now, this was a great opportunity for a value-based investor to be able to go in and look at an opportunity like this. And when we look at the next slide, you can actually see what happened over the same time period to Life Healthcare's foreign ownership. So the red bar chart here shows you the foreign ownership of Life Healthcare from 2015 through until 2021. Now, back when it was a darling of the market and when South Africa was more prominent in the index, you also have South Africa's weight in the index there. You can see that Life Healthcare had a foreign ownership of almost 60%. When you go through to 2021, that foreign ownership had come down to around 20%. So you can see it had largely been forgotten about by foreign investors compared to where it had been in the past. And we've got one more example on the next slide, which is Metro Bank. So Metro Bank is the second largest bank in the Philippines. Now, during COVID, financials were some of the worst performing stocks because people were very concerned about the credit losses that could come about due to COVID. Now, Metro Bank was similar to other banks in that regard, but they acted very sensibly. They had a strong balance sheet, and they also showed a commitment to shareholders by looking to reduce costs as well as to looking to increase their payouts to investors in terms of dividends. As a result of that, we had belief in the company that they would be able to withstand what had happened because of COVID. And if you were to look at it through a long-term lens, which is what we do, with looking at things on a 3 to 5 year basis, you could see the value coming through. And you've seen a subsequent rebound in the stock price. But similarly to life healthcare that we discussed in the previous slide, when we look at the next slide, please, you can also see what's happened here in terms of the foreign ownership for Metro Bank. So the yellow line here is Metro Bank's foreign ownership. You can see back in 2015, 35% of the stock was owned by foreigners. By the end of 2020, that had gone down to 25%. So a meaningful decline in foreign ownership. Again, similar to what happened to the weight of Philippines in the MSCI index. So that's my final slide. And with that, I'll hand it back over to Adam. Thank you.
Great. Thank you very much, Navin, and thanks to Ken. We're going to leave obviously a couple of minutes for Q&A. I just want to wrap up very quickly here. I just want to reiterate, of course, China's faced some significant headwinds this year with COVID slowing global growth and obviously the geopolitical challenges that we see between China and the US. China is likely to see turning fortune sometime in the second half of this year. And this is over on slide 40. And so China's likely to see that growth trajectory change, assuming the government can stimulate the economy. And as Ken pointed out, China still faces a lot of policy options in which to use at its disposal to reflate growth, and has a lot of advantages still in its manufacturing supply chains, which is likely to sustain over several more years. Finally, Navin discussed there may be many reasons why investors might consider separating China from the rest of their global emerging markets exposure. Size and opportunity, and that crowding out effect is one reason. GEMX China is a larger market than Japan, which of course has its own discrete allocations, and separate allocations could allow nervous investors to deal with those discrete country risks individually rather than in a single catch-all GEM, global emerging markets portfolio allocation. With that, I think we're going to turn it back to Alicia, and we're going to open it up to Q&A on our panel. But thank you very much again for everybody for joining us.
Thank you very much. It has been very interesting, really amazing how important. I mean, sometimes we do not realize how big China is in the emerging markets. But yeah, not surprisingly, we have more questions about China than about the rest of the emerging markets from the audience. Specifically about the A shares market, we have a couple of questions. Maybe we can combine them. First, can you please elaborate on why is there such a low correlation between the A-share markets and the Standard & Poor's, for example? And also, in which sectors in the A-shares market are you seeing more opportunities at the moment?
Yeah, so in regards to correlation, that's a very good question. Where specifically, A shares historically had, I would say, a more difficult, sort of a barrier in terms of, or difficult entry barrier, because investors needed previously to use a Q fee or RQ fee quota in order to invest. But of course, over the past few years, that's changed because of the Hong Kong, Shanghai, Shenzhen Stock Connect program, where you can buy the A-share stocks via the Hong Kong Stock Exchange. But overall, I think just the overall, sort of when you look at the demographics, the investor profile in the markets are quite different, right? The fact is that when we look at the U.S. markets, they'll tend to be sort of, much more institutional driven. Retail investors do not have such a large participation rate as you do within the A-share side. If you look at the A-share markets right now, you're still getting 80 plus, 85+% when it comes to retail participants. Sort of retail investors do dominate the A-share markets. So that is why, because of those reasons, we do see the correlations actually with A shares being low, not just with S&P 500, but for a lot of other markets as well. And then when it comes to specifically what sectors we're looking at right now a lot of the new economy sectors, which are standing to benefit from policy tailwinds, which we feel in the second half of the year, these companies should stand to benefit. So whether be it some of the EV new energy, or sorry, the solar EVs, specifically new energy. We'll look at also some of the more semiconductor related names, and also more recently, as I mentioned earlier, we've been adding on a bit of exposure towards property as well, because we feel that there could be actually some surprises in terms of growth, at least in the short term. And that's why when we do some of our top down overlays, we're putting a bit more exposure towards property, because as I mentioned earlier, if China is going to lower interest rates further, relax mortgage rules and so forth, that could have a strong positive sort of boost towards the property sector in China.
Thank you very much. Actually, we have time maybe for one more question. There's a question about your 4% growth projection for China, and actually the question is a recession possible in China? Do you see that there's a way in which China could actually, what could go really wrong, and is a recession possible for the Chinese economy?
I mean, anything is possible, right? The fact is that it would be probably, I would say, a bit more. The government will probably not allow for sort of China to have negative economic growth. Obviously, we know for a fact that this year is going to be very important for President Xi Jinping, because he's going to be be elected to a third term in terms of running China. So we feel that having negative economic growth for this year is probably not in the cards. But at the end of the day, the fact is that we're not just looking at short term. We're looking at sort of what's likely to happen 5 years from now or 10 years from now, because we are very much sort of medium to long term investors, and our focus is actually more about the quality of economic growth. And knowing what's sort of at stake, we feel that China is going through this transformation where consumption will have to be a much bigger part of its economic growth, and also being more self-reliant on technology will also have to be very important for China.
Okay, thank you very much. I think we actually do not have much more time. Maybe we would like to ask Matthew to join us again for some final remarks and to say goodbye.
Thank you, Alicia. I just want to thank everybody for joining us today. And one of the key messages we want to leave you with is Eastspring as Asian experts. As questions come up on China, as questions come up on Asia, please feel free to reach out. We'd love to help you out. And we think it's an exciting opportunity. And hopefully today you found our session helpful, informative, and we look forward to working with each of you going forward. So thank you, everybody.
Thank you very much, Matthew. Thank you to all of you. I want to remind our FPA members that the exam is already posted on the FPA page, and it will be there until the 25th of May at 10 p.m. in the night, European time, so you can access the exam there. And I also want to remind all of you that this event has been recorded. You will be receiving the recording of the program in the following couple of days, and please feel free to reach out to our friends from Eastspring Investments for any follow-up questions. Thank you very much to all.